On Business Incorporated today, Egypt, the United Arab Emirates and Jordan sign industrial partnership for sustainable economic growth. Central African Republic to launch official digital currency hub. Plus, manufacturers in Nigeria react to the hike in monetary policy rates. Hello and welcome to the program. I'm Will Ibang. Let's start off the program with intraday market numbers. Here in Africa is mostly negative today. In Nigeria, the all-share index shed 0.41%. Looks like some profit-taking activity from last week's gains, while South Africa's JSE index is up 1.49%. In Egypt, the market session was positive by 0.65%, while Kenya closed Friday's trading negative, down 0.26%. In the Middle East, market sentiments were all positive in the UAE. Both the Abu Dhabi and the Dubai Financial Market Index were up by more than 2% and 1.52% at intraday. Elsewhere within the region, Saudi Arabia Tadawal was up 1.40%, while the Qatari index wasn't left out. It was up 0.25%. Now over to Europe, where the EU summit kicks off today, and pressure is on leaders to agree further economic sanctions against Russia, which so far has proven elusive. They're also expected to give further backing to a $9 billion package to help Ukraine's government financially afloat. Rob Watts is in Berlin with the updates. Hello, Rob. Are there high expectations of this EU summit?
Well, the key question hanging over this summit is whether or not an agreement can be reached on a sixth round of sanctions against Russia. Now, talks over the weekend failed to agree on the main thing that's getting in the way of a deal, and that's a proposed embargo on Russian imports of oil. It's an idea that is vehemently opposed by some member states, including Hungary, which says it's a red line, this idea of stopping imports of Russian oil. The Czech Republic and Slovakia are also against the idea. All three countries get large proportions of their oil from the Russians, so that's the main reason why. A proposal floated last week had a carve-out for oil delivered by pipeline, so only blocking sea imports, but there was no agreement on that over the weekend either, and it's unclear whether a deal over an oil embargo will be reached today or tomorrow. EU officials say it's possible, but Reuters is reporting that draft conclusions for the summit include little change when it comes to sanctions. The oil issue is key because it's blocking the entire package of sanctions from being passed, including disconnecting Russia's biggest bank from the SWIFT messaging system, banning Russian broadcasters from the EU, and banning more influential Russians from travelling to the European Union. The state of things was laid bare on Sunday when Germany's economy minister Robert Habeck warned that EU unity over sanctions was starting to crumble, as he put it.
Now, so are we likely to see anything concrete out of this meeting?
Outcome is expected to be the leaders giving their backing to a €9 billion package aimed at helping Ukraine's government to survive. Kiev is in desperate need of money over the coming months to keep the wheels of government turning and to pay wages, for example. The EU is hoping the money it provides will enable the Ukrainian government to keep going for another couple of months at least, and it has promised to continue supporting Ukraine beyond that. EU leaders are also expected to pledge to help accelerate work to get a backlog of Ukrainian grain shipments out of the country. Russia's navy is blocking the key Black Sea ports from which Ukrainian wheat, for example, would normally be delivered to the world, leading to what some world leaders have called an impending global food crisis. So the EU says it wants to step up efforts to help Ukraine get those shipments out through rail and road instead of by sea.
So how are things looking at the start of the week for European markets?
Well, investors will be hoping to follow up on a strong week last week that saw the pan-European Stoxx 600 index gain 3%. It rose 1.5% on Friday alone. And also Germany's DAX ended the week at its highest for a month, having risen by 1.6% on Friday. Traders will be watching the summit I've been talking about in Brussels closely for any movement on things like oil sanctions and moves to curb energy prices as well. We may also see some of the good feeling from Asian markets on Monday spill over into Europe. Asia stocks rose as China began to ease some of its strict COVID restrictions in Shanghai and Beijing. They also benefited from some healthy data from the US economy on Friday. As for the euro, it's holding on to gains made during last week as a result of some hawkish talk from the European Central Bank. With European markets somewhat stable, the central bank has indicated that a rates rise could come as soon as July, as it looks to bring down inflation of 7.5% at the moment back towards its target of 2%.
Thanks so much, Rob, for that update. We'll keep a watch on what's happening and possibly the outcomes you mentioned from the EU summit. Thanks again, Rob. Now, over to the UK, where rising food price is taking center stage. We'll talk to Simon Pusey in London to get more information on that. Now, Simon, budget pasta prices have risen by 50% in the last year. I guess budget pasta is no longer budget pasta.
Yeah, so according to the Office for National Statistics, the lowest cost version of pasta did rise, as you said, by 50% in the year to April. According to its data, the price of crisps also rose by 17%, and bread and minced beef grew by 16%, and rice prices rose by 15% or more. But this isn't an overall trend. Some everyday items have shown a drop in prices, led by potatoes, which were down 14%, cheese, pizza, chips, sausages, and the price of apples were also lower. And if you look at the average price rise of 30 budget food items at supermarkets, it was actually a rise of 6.7%. That's below the rate of inflation. That's not to say that things can't get worse in terms of rising food prices. The situation in Ukraine and Russia, which produces 30% of the world's wheat, shows things probably will get significantly worse, and the prices of things like pasta will probably continue to go up.
So Sainsbury's also making some commitments to show up some food prices there. But earlier today, we saw the report on projected power cuts due to energy shortages. Meanwhile, each household in the UK is expected to receive £400 from the Windfall Tax. Is this grant factored into this report?
Yeah, so the two slightly different things here. One is the government modelling of a worst-case scenario which predicts major gas shortages in winter if Russia cuts off more supplies to the EU. That describes a scenario where as many as 6 million households in the UK could face power cuts. But again, that is a worst-case scenario model. The windfall tax, on the other hand, is definitely going ahead, as was announced by Rishi Sunak last week. It means £400 will be given to each household, and poorer pensioners and disabled people would also receive extra grants on top of that. But these are two separate issues. Those grants won't be too much help if 6 million households have the power switched off because Russia cuts energy supplies to Europe. But people will be getting those grants come what may, whereas the earlier thing was more of a worst case scenario, and it was the government sort of preparing for the case where Russia decides not to give any energy to the EU.
So the market's also preparing. How are the markets looking at intraday, Simon?
Yeah, so UK equities in the green today with a sort of ripple of relief helping stocks after authorities in Shanghai announced a lifting of restrictions from Wednesday. And the hope is that maybe the global market will pick up because China's, the world's second largest economy, was slowing in terms of its growth because of those lockdowns in Beijing and Shanghai. On opening, the FTSE 100 actually hit a one-month high, up by 0.3%, although later that dropped. So at intraday trading, FTSE all-share, it was up slightly by 0.09%. The FTSE 100 up by even less, by 0.3%, and the FTSE 250 up by over 0.5%, by 9.65%. Meanwhile, the pound also up on the US dollar by 1.8%, down on the euro, and up on the yen by just 0.25%.
Thanks so much, Simon, for that. We'll keep track of the markets and hopefully more updates on what's happening in the UK. Thank you so much for joining us.
Thank you.
Now, shares in Asia Pacific rose on Monday as investors look ahead to major economic data releases later in the week. Japanese stocks led gains among the region's major markets, with the Nikkei 225 rising 2.1% as shares of robot maker FOREX jumped 4.66%. The Topix index surged 1.8%. Hong Kong's Hang Seng index also saw robust gains, climbing around 2% as of its final hour of trading. Over in mainland China, the Shanghai Composite closed 0.6% higher, while the Shenzhen component rose 1.04% to close. The Kospi in South Korea closed 1.2% higher, while Australia's S&P ASX 200 ended the trading day up 1.45%. Oil prices rose to two-month highs early on Monday as traders waited to see if the European Union would reach an agreement on banning Russian oil ahead of a meeting on a sixth package of sanctions against Moscow for its invasion of Ukraine. Brent crude futures gained 0.4% to $109.89 a barrel, while U.S. West Texas Intermediate crude futures jumped 0.5% to $115.67 a barrel, extending solid gains from last week. The EU is due to meeting today and tomorrow, Tuesday, to discuss a sixth package of sanctions against Russia for its invasion of Ukraine, which Moscow calls a special operation to disarm its neighbor. Any further ban on Russian oil would tighten the crude markets already strained for supply amid rising demand for gasoline, diesel, jet fuel ahead of the peak summer demand season in the United States and Europe. Now, gold prices firmed in choppy trading early on Monday as a weakening dollar buoyed greenback price bullion, although gains were capped by some investors turning to riskier assets in Asia. Spot gold was up 0.2% at $1,856.86 per ounce, while U.S. gold futures edged 0.1% higher to $1,859.40. Federal government offices, stocks and bonds markets, and the Federal Reserves are closed today for the Memorial Day holiday in the United States. While spot silver rose 0.1%, platinum firmed 0.1%, and palladium gained 0.8%. So with the monetary policy rate raised to 13% at the last Monetary Policy Committee of the CBN, manufacturers say effect has led to a surge in forward purchase, consequently a hike in inventory cost. The managing director of Coleman Wires and Cables, Mr. George Onofo-Okon, who was a guest on our Business Morning program, says this may have become the practice for most manufacturers. One of the costs of this is, however, is high inventory cost. Let's take a listen.
So you're finding out that most manufacturers are now buying literally forward of their projection of the risk that they associate to prices going up. So I see maize going up and I need to use maize for my manufacturing. Instead of me buying 100 tons, I buy 500 tons. If you look at that, yes, manufacturers are buying more. The market is moving more. But we're indirectly turning ourselves to bankers. Yes, that's what to say. If you look at the amount of stock you're carrying, our inventory level, safety level, for instance, for ourselves, can be as high as 6 months. In some cases, as high as 9 months. So if you're taking inventory stock of 9 months, you take the financial cost of a 9-month stock rolling into in every manufacturer's warehouse. We are a bank. So billions and trillions of money is tied up in inventory unnecessarily because we're all speculating two major things: inflation, gap, movement risk. We're also looking at the FX risk.
And that was the CEO of Coleman Cables, Coleman Wires, Mr. George Onofo-Okon. Next, more stories on the African continent, and that's right after break. Do stay with us. Welcome back. Zimbabwe last week announced that it is easing controls on the national currency's official exchange rate, allowing it to converge with an interbank rate that the government has permitted businesses to use for commerce. The currency now officially trades at 290.88 Zimbabwean dollars per US dollar, according to data published last Thursday on the central bank's website, after starting the year at 108.66 Zimbabwean dollars per the US greenback. The interbank rate is at 296.68 Zimbabwe dollars. To get a better understanding of the impact this has, Opalua Dapo Thomas, international financial analyst, joins us. Hi, Dapo.
Hi, hello.
Now, what's the situation in Zimbabwe regarding the exchange rate with the US dollar?
Well, it's quite shocking. And let me give you a background to it. So a few weeks ago, analysts, we just woke up to the news that the Zimbabwe dollar was going to be sold to the US dollar at 279 Zimbabwe dollar to a dollar. But that's quite shocking because the Friday, that's the previous week ending, the US dollar was sold at 165.99 Zimbabwe dollar to a dollar. So that's about 40% devaluation. So, I mean, we found out, obviously, the reason for it, but because on Saturday, there was an announcement by the president, that's Emmerson Mnangagwa, who was basically saying that he wants everyone, retailers and wholesalers, to adopt the willing buyer, willing seller rate. So what he's trying to do is trying to eliminate all the multiple exchange rates in the country. So in Zimbabwe, there's an auction rate, and the auction rate happens every Tuesday. I mean, we get to know the auction rate every Tuesday when willing buyers and willing sellers come together, bid and ask for dollars. I mean, people that want, manufacturers that want to import different things from different countries, raw materials, consumables, electricity services, thereabouts. So they come look for the allocation of dollars. So you have willing sellers as well. But that rate is different from what we see in the interbank rate. So the interbank rate obviously is determined by the bank, and obviously they look at demand and supply. But there is a black market rate, just like we have in Nigeria here, where in Zimbabwe is at around 400 and something dollars to US dollars. So what invariably is happening is there's too many multiple exchange rates, and that basically is affecting investors' confidence.
So I know that the Zimbabwean government has tried several methods or strategies to tame the local dollar decline, but are we seeing the effect of these FX inconsistencies on inflation?
Oh, yes, certainly. I mean, when you have exchange rates and volatility or exchange rate inconsistencies, you basically see it in the price of goods and services in the country. I mean, now let's look at it in the long time frame. June 2019, inflation was about maybe 100%, and then obviously it skyrocketed to 800% by June 2020, and then it came back to below in June 2021, came back below 64%, and now we are seeing a touch of 100%. Food prices about 150%, month on month 25%. This economy is a sensitive economy to global shock. So obviously, you now imagine the impact of the pandemic, imagine the impact of the coronavirus. I mean, and then also we're looking at this Russia-Ukraine situation, and this thing is having a spillover into the Zimbabwean economy. It's very, very sensitive to economic shocks. I mean, high commodity prices will mean that larger allocation of dollars, which they don't even have. The Zimbabwe economy does not have. May mean that it makes prices of goods and services expensive. So the manufacturers are crying and they're laboring, saying, we don't have enough FX. So how are we going to handle this situation? And this is basically going to affect people, because right now, how much is it a ton of maize sold now? It's different from what it was last month. Like I said, food prices went from 150%, as high as 150%. And we need to understand the context of this, that the Zimbabwean dollar is the worst performing currency in Africa. So when you see it, sensitive to things like this, obviously it affects inflation.
And so the government did try a 10-day ban on bank lending. How did that go? Was that effective, or it didn't work? It's one of the strategies that didn't work. What didn't work there?
Well, the thing with currency, I won't call it currency manipulation, but the thing with when you fix money, when you try and fix exchange rates, or you're trying to alter rates, today you are using a pegged rate, tomorrow you're using a hybrid rate. Today you're saying, okay, you want to float the dollar to the local currency. All those things are, what would I call it, futile, or an exercise in futility if there are still structural issues. Now, the problem here with the Zimbabwean economy and the Zimbabwean government is a lack of fiscal discipline. The lack of fiscal discipline, that whereas you're exceeding your budget. I mean, last year, look at it, third quarter of last year, 2021, the Zimbabwean government exceeded their budget by 71%. So when you see things like that, and you are spending more dollars, you have, when you're saying you're not lending it, you're basically putting a what do you call it, a cap on goods and services, putting a cap on manufacturers' demand and supply. So once you affect that, it's not going to work. When you just say, okay, you want to ban, I mean, we've seen it in different countries, even in Nigeria as well, where you are halting the increase of the supply of dollar. I mean, you create a black market rate because people who have access to this would then go and sell it at a premium on the black market rate. At the end of the day, you're not fixing anything. So the strategy doesn't work. And that's why people are very, very skeptical about it.
So do you see, because you mentioned inflation, and I don't know if you mentioned that it's, surged about 132% in May. That's the highest, that's the first time it has crossed 100% in 10 months. How do you see this? Do you see this going higher, or do you see it, peaking at some point and just going, dropping down?
Well, I see it's going higher. I mean, I was listening to the finance minister of the Zimbabwe government a few days ago, and he talked about how the local currency is being affected because of the rise in greenback. I mean, that's the rise in the US dollar. So I see it's going higher because the US dollar is going higher as well. And then obviously commodity prices, we're in a commodity super cycle now, where you see commodities like copper, gold, oil, and gas, and like we've rightly spoken about, is affecting how economies react. So now, this is a country that is very import dependent. It's a very, very import sensitive economy. Now, if everything is going up higher, we're having supply chain shocks as well. So if you're having this issues going out externally, effectively, it's going to say, okay, it's going to affect the economy, because how do they find a way to mop up all the, how would I put it, all the effects of what's going on outside? So it can't peak anytime soon until things change. So if you're having a rising cost of commodities outside, then you're going to certainly you're going to have rising cost of goods inside, because they import these things. And now with a lack of or inadequate effects, then there's going to be a big problem. So those are two issues that are going on externally and internally. And now, obviously, we have to understand that they have a high debt profile. I mean, they can't really pay most of their debts, and then they're looking at really giving out gold and platinum, or giving out some of their commodities to stand for them as credit worthiness. But then those are the issues we're having in the Zimbabwean economy.
So with all this happening, do you think the Zimbabwe will go back to using the US dollar as the legal tender? Abandon their local US currency in dollars?
Well, I can't write out that idea. I can't write that. I mean, we can't rule it out, because the truth is they've done it in 2019. Even if the country economists, I mean, no economist will support you to use another currency for your own legal tender. But I think they've come to a dilemma where they have to do what's important and not what's right. So if they say, okay, I mean, hyperinflation has ruined the local currency, and it's possible that in 2019, when we're seeing hyperinflation happening, which we're having the same scenario now, we're seeing it happen again. So the truth is, they've got no choice. I mean, it's a choice they have got to look at. It's an option they have to weigh on. Although nobody would obviously support it in theory, but this is not theories. This is not a game of theory. This is a game of real life. These are people's lives here. So how do you see, or how do you maximize the effective use of FX? Maybe if they use it as a legal tender, then that gives the local currency life to relaunch, while right now is declining day on day. I mean, today is 295 to a dollar. Last week was about 270. So who knows how long it will spiral. So these are the issues, but it's possible they are looking at it. It's an option they've got to look at. I mean, the central bank governor wasn't dissuaded when people talk down about it. So it's something they're looking at. I mean, but what they have to do is try and bring back confidence into the Zimbabwean economy.
Okay, so just before I let you go, do you have any policy recommendations you think something can be done? What would you recommend for the Zimbabwean government, especially for their dollar?
Oh, yes, certainly. I have a lot of policy recommendations for the Zimbabwean economy. The first thing they have to do is to go back to the drawing board to see how they can improve the supply of dollars into the economy. I mean, like I said, import substitution is the panacea for exchange rate volatility. So if they produce things, I mean, they export a lot of things, tobacco, sugar confectionaries, and different other raw materials. But how can they make a services based industry where people can come in and investors can come in and bring dollars? I mean, even the average man knows that the Zimbabwe economy is not what I call it excellent. I mean, everyone mocks the Zimbabwe currency. So how do you restore confidence and perception into the economies? By being producing. If you produce stuff, you have what I call it. If you produce stuff, you have people coming in, bringing in dollars, and also you need to bring back confidence into the economy. And the only way you can do that is by having fiscal discipline. You're not going to exceed your budget by 71%. That is wrong. So when you stop printing money, you live within your means and produce, then again, we'll bring them to your economy.
Thank you so much, Okpoluwa Dakwa Thomas, international financial analyst. Thank you so much for joining us on the program and sharing your thoughts with us.
Thank you for having me.
Now, Egypt, the United Arab Emirates and Jordan have announced an industrial partnership for sustainable economic growth in Abu Dhabi to unlock new industrial opportunities. The partnership aims to achieve sustainable economic growth across 5 sectors, which include food and agriculture, fertilizers, pharmaceuticals, textiles, and petrochemicals. Also, a $10 billion investment fund has been allocated to fast-track the investment objectives. According to the UAE's Deputy Prime Minister and Minister of Presidential Affairs, His Highness Sheikh Mansour, the partnership would also enhance industrial integration with Arab nations and the rest of the world. The Central African Republic, CAR, has started to unveil its digital currency-focused initiatives. The country's President Faustin Archange Touadéra announced the first crypto initiative called Sango, which he says has the potential to transform the country's financial system. According to the government, Project Sango will be a crypto island where digital currency trading will have legal recognition, the first of its kind in Africa. The legal framework for the implementation is already being worked on and will be ready before the end of the year. Specific provisions in the framework include 0% corporate tax, citizenship by investment, digital ownership and identity. It also includes laws for tokenization and crowdfunding. And that's it on the program today. Thanks for watching. I'm Willie Bang. Bye for now.